Everyone's watching the AI boom, but at Insightful Value, we're looking at something way more grounded and surprisingly overlooked. We dive deep into companies flying under the radar, like Domino's Pizza Group, where the stock price is unusually low right now. This is not financial advice, just informational and educational content to help you think differently about where value might be hiding in plain sight. Domino's Pizza Group, listed in the UK, is the master franchise of the Domino's brand in markets like the UK, Ireland, and a few other territories. You probably know them for the pizza, but under the hood, it's a lean franchise operation, not a restaurant-heavy business. They don't run the stores, they empower franchisees to do that, which gives them capital-light scalability and predictable revenue streams. The current dip in share price isn't about a failing business, it's about sentiment, short-term headwinds, and broader market movements. Financially, Domino's Pizza Group has held up with solid fundamentals. Revenue has been growing modestly, hitting over $600 million in recent years. More interestingly, their operating margin has typically been above 15%, which is high for a food business. That's partly thanks to their franchising model, which brings in fees and royalties without the massive operating costs. The company consistently returns cash to shareholders through dividends and share buybacks. The dividend yield is currently attractive, hovering around 4%, a solid return in a low-growth environment. Earnings have been a bit pressured lately due to inflationary costs, marketing investments, and labor dynamics across franchisees. But these are not structural issues, they're cyclical. Management has been actively addressing these challenges with tech innovation, supply chain optimization, and a focus on digital ordering. Over 90% of orders come through digital channels. Domino's has one of the most advanced tech stacks in food delivery, and that's not an exaggeration. What makes this even more interesting is the low valuation. The stock is trading at a PE ratio that's well below its historical average, suggesting that the market has baked in a lot of pessimism. For long-term investors, that might be an opening, especially since the company is still generating strong cash flow and has manageable debt levels. They've also been expanding their store count in a measured way, opting for quality growth over aggressive expansion. Recently, Domino's signed new franchise agreements and has committed to store refurbishments and brand refreshes to stay relevant with younger audiences. Plus, their marketing partnerships, like with major sports events and platforms, continue to drive brand recognition. So why is the stock price low? It's mostly macro: inflation pressures, consumer spending fears, and overall market rotation out of boring names. But boring can be beautiful, especially when it's profitable and overlooked. At Insightful Value, we break down these kinds of stories. We provide in-depth analysis of undervalued companies like Domino's Pizza Group. No fluff, no jargon, just clear insights that help you see what others might miss. Whether you're deep into value investing or just starting your journey, our mission is to simplify the complex and make investing more understandable and strategic. For more details on this company and others like it, visit insightfulvalue.com. We've got full reports, data breakdowns, and curated watch lists to help you find potential opportunities before the crowd catches on. Thanks for watching. Subscribe to our channel if you haven't already, and definitely check out insightfulvalue.com for more content like this.